You're listening to Sound Money from Casey Research.
Hello and welcome to the Sound Money Show from Casey Research with me, your host, Andrew Duncan. It's my pleasure today to be speaking to Harry Dent, editor of the free newsletter Survive and Prosper. Today we'll be talking about the current economic situation, its prospects, what strategies can help us all survive and prosper, and whether sunspot cycles affect markets and the gold price. Hello, Harry.
Well, hi, Andy.
Some people use Austrian economics to predict the future. Some people use ethics, psychology, and chaos theory, but you're famous for using demographics. What's your latest thinking on whether we're inside an economic crisis? And if we are, is it going to get better soon, or is it going to get worse?
Well, first, it's going to get worse. I mean, we predicted 20 years ago that the baby boom generation in the United States would peak in their collective spending around 2007. And Andy, let me tell you how simple this is. It's like life expectancies for actuaries. We know when people spend on everything from cradle to grave, and people spend the most money in countries like the United States at age 46. So if we take a 46-year on the birth lag to reflect a new generation earning and spending more money, borrowing, buying homes, all this great stuff, we would have a boom from 1983 to 2007, which is exactly what we had. Now, ever since, the demographics have been declining. Once people's kids get out of the nest, it's not that they retire at first. Their kids get out of the nest, and they start spending less on their kids, and they save for retirement, and that causes the economy to slow. And this has happened in the last century 2 times, between 1929 and 42 and 1968 and 82. A generation stops spending, slows until the next generation comes along. So we're fighting, the governments are fighting a natural and a dramatic slowdown in spending, because the baby boom is the largest generation in history, and the drop-off in births was substantial for Generation X, they call it. So that's number one. But number two, as anybody at Casey Research knows, we had also the greatest debt bubble in history. We've been running trade deficits, budget deficits in the government since the early 70s. Between 1983 and 2008, in the boom, not only did government debt and deficits continue to grow and trade deficits, but private debt went from $2 trillion to $42 trillion, 3 times the government debt at the top of that bubble. So this debt bubble has to deleverage, just like the one after the Roaring 20s and the one after the railroad boom into the early 1870s and the land boom westward in the 1830s. These bubbles have to deleverage. So governments are madly stimulating to keep these bubbles from deleveraging, and they've been successful rekindling the markets, rekindling the economy. But it's taking $2 trillion on average in the U.S. alone of monetary stimulus and fiscal stimulus just to create 2% GDP growth, which is well below closer to 4% averages. So we had everybody's like, why is this recovery so bad? It's because the fundamental trends are horrible. Debt needs to deleverage. We've got huge debt burdens in the private and government sectors, and government's running up more debt than the private sector is deleveraging, and they're keeping the private sector from deleveraging by just throwing money at the banks, and they don't have to write down loans. So these are the fundamentals, and these fundamentals continue to point down, as well as geopolitical cycles that have been negative since 9/11, into at least 2019 or 20. So governments are fighting a battle they can't win, and I think we're getting stretched enough again that all it takes is another trigger like the subprime crisis in the U.S. I mean, 4 states basically led a subprime crisis in the U.S. that caused a whole global downturn in stocks and many real estate booms to bust around the world. This couldn't happen because of 4 states. It happened because the system was already stretched with debt twice as much as in the 1920s, and demographics are slowing down in almost every developed country. And guess who comes next off what I call this demographic cliff? That's a new book I have coming out in January. It's like, okay, Japan went off first in the 90s. We predicted that. U.S. after 2007, we predicted that. And next is Europe. Europe hasn't even fallen off this demographic cliff yet. They've been kind of in a peak plateau, and they already have a debt crisis, and they have Southern Europe in depressions, and the rest of Europe off and on in recessions. What's going to happen when more and more people spend less money just naturally as they age, and all this debt weighs more? And of course, Japan's been in a coma economy for 2 decades now because they've used QE to keep from deleveraging their debt debt deleveraging frees up cash flow. It kills banks, yes. It hurts some businesses. It even hurts the economy short term, like in the early 1930s. But it takes debt burdens off the private sector where you can innovate and grow and spend again. So to me, the government's doing all the wrong things. They've stretched this thing, created another bubble, and bubbles only do one thing: they burst. I think this bubble in stocks, it's already started to burst in real commodities. I think it's going to burst again in stocks and real estate starting in early to mid next year.
Now, some people say the 1929 depression ended in 1940, some say 1946, and some say 1954, which is about 25 years after the start of the depression. Do you think that the current thing we're going through now could last 20, 25 years?
I don't think that long, but I think it's going to last at least, overall, I think the economy in developed countries are going to be in a funk into the early 2020s, and that includes a 30-year commodity cycle that's peaked and turns down, which hurts emerging countries. And I think the worst will occur on all of our cycles, including sunspot cycles, as you mentioned earlier, but we've got much bigger cycles than that all point down together between 2008 and late 2019, and then our more intermediate cycles point down between 2014 and 19, and especially in 2014 and 2018. So I think the worst is yet to come. Governments have kicked the can down the road, as we all know. And I think they've stretched this bubble so much. Stocks are at new highs. Do they deserve to be there? Well, yeah, earnings are up for companies, but 40% of the increase in stock prices has come from buybacks. Just higher earnings per share from companies using very low, super low interest rates and cash on their balance sheets that they're not investing in the future because companies have overexpanded in the boom. They know that consumers are over in debt, not growing, and they know that this recovery is largely stimulus-driven. So they're not investing. They're buying back their own stocks. Governments are floating more and more debt and buying their own debt. I mean, this whole recovery is totally from quantitative easing, fiscal deficits, and government stimulus, and it can only stretch so far before the fundamentals catch up. And I think, again, I think we've stretched enough. We've got some major patterns in stocks. I call it a megaphone pattern on the Dow, where each bubble, like 2000 peak and then 2007 and then now here in late 2013, early 2014, each peak takes you to higher highs and each crash takes you to lower lows. I've never seen a more obvious pattern. This is the same pattern we saw in the peak in the last generation between 1965 and 1972, before the great 73 to 74 crash ended the bubble and ended the downturn. So I think that's what we have ahead of us, unfortunately.
Are there any deeper underlying trends you can identify which are going to pull us out of this greater depression?
Oh, yeah, two things. I mean, what people don't understand, and what the government is making a huge mistake here, they're killing the golden goose. All this endless quantitative easing, propping up the banks, bailing out companies, keeps the old economy from failing, as it did in the 1930s and 1970s, in between generation cycles of spending. This is a natural cycle. When the old economy fails, a new economy, new innovations emerge, and a new younger generation benefits from the price of housing coming down and financial assets coming down. Now they can buy this stuff at a better price. They benefit from lower interest rates. They benefit from lower debt burdens. So all of the things that the governments are preventing with all this quantitative easing are the very things that turn around our economy. But how is the next generation, the echo boom I call them, or the millennials some people call them, how are they going to grow when they're still living at home with mom and dad because jobs aren't good? And housing's still unaffordable even after the level of crash we've seen, and it's going back up now. So you need, the economy knows how to rebalance, just like any natural system, just like your own body. If you eat bad sushi at a restaurant and get food poisoning, your body will flush it out so fast, and that's what the economy tried to do in 2008. Systems were melting down, a lot of debt was deleveraging, and the government just said, no, we're not going to let this happen. They are killing the golden goose, and Japan is the proof of this, because Japan's echo boom generation peaked earlier in between 1989 and 1996, as we predicted. Nobody else saw that coming, because only demographics would have told you that they would have declined after they looked like they're going to take over the world. But they never let their debt deleverage. So they still have In Japan, you've got people paying off mortgages that are still more than the value of their home after home prices dropped there 60%, never bounced, and commercial real estate's dropped 80%. So Japan's been in a coma economy. They should have recovered starting in 2003, and they started to, but because they didn't let the debt deleverage and the economy rebalance, they've been in a coma economy now for 22 years, 23 years, 21, 22 in real estate, and they only started to come out of it with massive stimulus, which won't last. I mean, because stimulus never lasts. So if we don't have a crisis, Tom Friedman, best-selling author, said if we don't have a difficult decade after 3 decades on steroids, we're going to have a difficult century. That's the way I look at it. We will come out of this with the next generation. It will not be as strong as the baby boom, but we can come out of this, especially with new innovations, biotech, nanotechnology, robotics, and alternative energy, things that are going to extend our lifespans as much as we did in the last century, maybe more. The demographic problem, which is around the world in developed countries, we got aging societies everywhere. Japan, Southern Europe, East Europe, Russia are the worst, but everybody, the U.S. at best goes sideways on demographic trends for the first time in our history. The answer to this is new innovations that increase our lifespans and allow us to work longer and make more money, invest more money, do all the things consumers do. That's the way to grow in aging societies. And if the governments keep stimulating and not, and protecting old industries and stopping new industry from emerging, we won't get out of this. And again, Japan's the proof of that. They should have turned around in 2003, and they're still in a coma economy over 2 decades later because they didn't let the free market system work. The very system that has made us prosperous, they are killing it.
Okay, let's assume then that the Titanic is going to go down. Some people did manage to make it to the lifeboats. For anyone listening to this, what strategies, kind of very simple strategies can they adopt to be in those lifeboats to survive and prosper through to the other side of this?
Yeah, and Andy, that's a great analogy. That's what we tell financial advisors in our network. You got to get people in lifeboats. You got to say, this is our job. We're not here to make you money. We're here to protect what you have after this bubble. Because in the last bubble in late 2008, before the governments turned it around with massive stimulus, everything went down. Real estate went down, gold went down, silver, commodities, international stocks, U.S. stocks, emerging country stocks. Everything went down except for safe cash and high-quality bonds. So that's the strategy. People think gold will protect you, but that was in the last crisis in the 1970s. When debt deleverages, you destroy the money created in the bubble boom. When financial assets collapse, you destroy wealth and money created in the bubble boom. And so there's fewer dollars chasing the same goods. That's the definition of deflation. People who are buying gold are betting on inflation, and of course that makes sense. Mass unprecedented money printing, how could this not cause inflation? But here we are 5 years into this, and inflation this year dropped from 2% to 1%. And it's very low in Europe, and it's been below zero in Japan until a massive stimulus program that only brought it up to 0.7%. You can't create inflation past a point in a deflationary, debt deleveraging, bubble bursting economy. So what you have to do is be number one strategy. If you want to be really safe, just be in T-bills, not in a banking account or savings account. Be in a T-bill account, safe in an investment account in your name that nobody can lend against, and let the bubble crash, and then buy stocks 65% and real estate maybe 30% lower, and gold or anything you value, or a beachfront property. Second strategy is bet on the U.S. dollar. Everybody thinks the U.S. dollar is going to go down. We're printing money. Yeah, but Europe and Japan and China are printing more than we are, stimulating even more. The dollar's only gone up since this crisis started in January 2008, and we went into recession, and it spiked 27% when gold fell 33% and silver fell 50%. So that's the hardest thing for most audiences I talk to. They think gold and silver will protect you. And yes, in the 70s, couldn't have been a better investment. But again, we're not in the summer season, I call it, with high inflation. We're in the winter season that shakes out everything, all assets, all businesses in the winter season. The third strategy, and this is the most important, because if a listener says, well, gosh, a lot of people, Peter Schiff and a lot of people say, well, yeah, we're going to have an inflationary crisis. Well, if you don't know whether it's going to be inflationary or deflationary, and I argue strongly, and I mean strongly for deflationary, stocks go down in an inflationary crisis like the 1970s or a deflationary crisis like the 1930s. They just go down even more in the deflationary scenario. You can hedge your portfolio by having a percentage of your portfolio, especially, make it as safe as you can, but have a percentage. Maybe you still need some dividends from some stocks and some more stable stocks, utilities and things like that, but have a portion of your portfolio short the stock market. If you want to bet on the S&P 500 going down, you just buy SH instead of SPY. It's an ETF. You bet on stocks going down, especially small cap stocks. The TZA is triple short small caps. If you just had a little percent, 10 or 20% of your portfolio short that TZA, and I'm right about a 60% plus decline in stocks, I mean, that little bit would hedge the rest of your portfolio. So cash for the most conservative, U.S. dollar index, UUP is an ETF for that to bet, because you can't just be sitting in cash. You have to bet on the U.S. dollar versus other currencies, and it goes up in a crisis like this. And third, be short stocks. Now, so any investor can take those three strategies and mix and match them to different risk profiles. You want to take more risk, short more stocks. You want to take less risk, be more in the UUP and just be in T-bills. But those are the only things proven by the last crash in 2008 to work in a deflationary downturn where debt starts to deleverage.
Now, we're coming up on time, but we did promise that we'd talk about sunspot cycles. Now, the latest peak has just happened, according to NASA, in 2013, and the bottom of this current sunspot cycle comes around 2019. Do you think this means anything, or is it just all a bit of fun?
No, I tell you, I heard this years ago from Robert Prechter and a number of people, and it was put out as an 11-year cycle. I study cycles. I study markets. I've never seen anything correlate on 11 years. But there was a decennial cycle from Ned Davis, who's one of the preeminent cycle people in America. And he has a decennial cycle that shows that most of the worst stock crashes and recessions tend to occur in the first 2 to 3 years of every decade, a la early 80s, early 90s, early 2000s, and early 30s and early 40s, and I could go early 60s, early 70s. I mean, almost every decade. But, I was expecting, I've been using that cycle for 2 decades now, I was expecting the worst of the crash to happen between 2010 and 12, and it didn't. We had up to a 20% correction, but on this cycle, you always get a recession, and you always get at least a 20% stock correction, and we didn't fully see that. So I'm like, oh, gosh, I guess QE just defeated this cycle. That's when Paul McCauley wrote an article in Barron's saying the Sunspot Cycle saved me from the 2000 tech crash. And I'm like, damn, this is a guy that managed, I don't know, $16 billion or something. This is a major fund manager. So I go back and look at the cycle, and they got this. NASA tracks this because it knocks out satellites. It affects infrastructures, astronauts and stuff. This is a powerful cycle of rising solar radiation. And you think, if full moons cause emergency rooms and police departments to get overwhelmed once a month, what could rising solar radiation do to, I don't know, human emotions or whatever? But I went back over Ned Davis's last 100 years and found, this is an 11-year cycle if you go back to the 1700s, but in the last century, it's a 10-year cycle. And this sunspot cycle, for whatever reason, because they are irregular, they may average 10 years or 11 years, this one went longer down. It peaked in early 2000, right when the tech wreck happened, and then it bottomed right when the real estate crash and the 2008 crisis happened. You tend to get the worst stock crashes in economic times at the beginning of the cycle turning down and at the bottom. Well, this cycle is peaking, and the best estimates from a guy at Stanford who's monitoring better than I've ever seen is that it's peaking right now, November, December. And it's going to turn down, like you said, into late 2019. Once a cycle gets going, it's easier to predict the rest of it. So I've got a geopolitical cycle turned down from 2001 to 2019, demographic spending cycles down from 2008 to 2020, and they don't turn up again until 2023, and a commodity cycle down from 2008 or 9 into 2023 or so. So all of these cycles point down now, including the Sunspot cycle, between early 2014 and late 2019. If we're going to have the next Great Depression, if this debt bubble and this government stimulus is going to fail, it's going to happen in the next 6 years. And on this Sunspot cycle, which I now consider a secret weapon because nobody knows about this. Everybody knows about Ned Davis's decennial cycle, but they don't know about this, and it's more predictable than his cycle, and it varies more. This cycle says the worst is likely to come between 2014 and 15, maybe 2016, and then again at the end of the cycle down between 2018 and 19. And this is important to me for investors because even in the Great Depression, we had a massive bear market from late 29 to early 42, where it went up and down and down. But markets were up as many years as they were down. It's just the down markets were stronger. You can't afford to just be out of this market. We just saw, the S&P, go up 150% in less than 5 years here. So you can't afford to be out. But what we're saying, the danger period is early 2014 into at least mid-2015 and maybe farther, and then again late 2017 or early 2018 into late 2019. If you're just kind of out of the markets and safe in those periods, we're bound to have a rebound in between like we've seen in the past. But I do think that what I call in my new book, The Demographic Cliff, we call it, the Great Deflation of 2014 to 2019. These bubbles are finally going to deflate after governments have spent 5 years throwing everything they can at the economy. And the truth is, economic growth keeps decelerating despite unbelievable stimulus. If we'd have put $2 trillion a year in the U.S. economy in stimulus in the 70s or 80s or 90s, we would have had massive inflation. We'd have had massive growth. The very fact that governments are stimulating so hard and getting so little inflation shows how deflation is the trend. And in deflation, almost all financial assets go down. So when your stockbroker says, well, we got you diversified in emerging markets and bonds and commodities and gold and real estate and all this stuff, it doesn't work. It doesn't work. This is the only time in the cycle in our lifetime, I call the winter season, where a bubble boom deflates like the Roaring '20s, and then everything goes down. So if you're not in cash or in cash flow investments, you lose. And if you are in cash and cash flow, you win unbelievably. You get to buy the world on sale when nobody else has cash or cash flow, and when you can't borrow from a bank if you tried.
Well, if everything suddenly turns up in 2019, I'm going to throw away all my books on Austrian economics. Now, it's been fascinating talking to you today, Harry. For our listeners, how can people best find you on the internet?
Yeah. The best thing, just go to harrydent.com. We have a daily newsletter, which is really good, high content. We're not making all our forecasts and doing the stuff we do in our broader newsletter. Really good way to get to know us. You just go to harrydent.com. All you do is put in your email address. Boom. You're on the newsletter for free.
Fantastic. Thank you very much for your time today, Harry Dent.
Thank you, Andy.
You can subscribe to The Sound Money Show on iTunes or sign up to our podcasts at Casey Research, where we'd also welcome your feedback and guest suggestions for future interviews. If you enjoyed listening to today's podcast, please let your friends know all about us to help us grow this podcast. Meanwhile, and until next time, goodbye.